Recording in progress.
Very good evening, one and all. Once again, to our monetary policy update and way forward. We cordially welcome everyone who's logged in both on the YouTube platform as well as on the live webinar platform. And we once again have our head of fixed income, Mr. Parijat Agarwal, who is here with us to share the news that we received this morning from the committee, and all about it with regards to how we need to handle our portfolios, what's coming our way. We hope that you would get answers for all of this today through this brief, short interaction. Before I hand over the call to my colleague, Mr. Parijat, I request you, in case you have questions, friends, please put it up on the Q&A tab. It's there right at your desk icon. You can use the chat box at YouTube link or the Q&A tab to key in your questions, and we'll be taking all the questions right at the end of Parijat's address. So without any further delay, over to you, Parijat, to take us through what's really happened today.
Thank you, Aarti, and welcome viewers. So today's MPC, I'll share the PPT with you, and then I'll explain as we go along. Is it visible?
Yes, ma'am.
Yeah. So today MPC announced they met on 3rd, 4th, and today the governor announced the outcome of the MPC. As you're aware, the MPC increased the policy repo rate by 50 basis points. So consequently, the standing deposit facility stands at 5.15%. It was 4.9% previously, and a marginal standing facility and the bank rate stands at 5.65. The SDF and MSF are at 25% lower and above the policy repo rate, which is at 5.4%. In terms of the stance, MPC also decided to retain their earlier stance of withdrawal of accommodation to ensure that inflation remains within the target going forward while supporting growth. So the repo rate hike was unanimous decision. It was decided by all the MPC members. There are 6 members, so it was 6-0. But the change in stance, or to retain the stand, was 5:1. 5 members voted to keep it as withdrawal of accommodation. 1 member differed from this view. In terms of the liquidity, the overall system liquidity continues in surplus with average daily absorption under the liquidity adjustment facility at 3.8 lakh crores during the June-July. Money supply and bank credit from commercial banks rose by 7.9% and 14% respectively. Now, the other important decisions was definitely on growth and inflation, which was outlined by the MPC. In terms of the growth for the fiscal year 2023, the MPC has retained its previous growth outlook, and real GDP for full year is estimated at 7.2%. Similarly, for inflation, the MPC has retained its previous outlook, and inflation is projected to remain at 6.7% for the full year. So if you take it as quarter-wise, the inflation remains at at 7.1, 6.4, and 6.7. Then again in first quarter of FY24 at 5%. So that's how the projections have been taken. There were some regulatory measures, but not too related with the market outlook, more on the operational and regulatory framework. Now, this chart depicts the liquidity in the banking system, as I mentioned earlier. So the liquidity, which is the denoted by the green chart, the green curve, it shows that liquidity remains in surplus and it is at 3.8 lakh crores in the banking system. It needs to be noted here that the MPC or the RBI mentioned that the gradual withdrawal of liquidity would continue from the system, but it would remain sufficient for the productive sectors to get credit from the banking system. So, the RBI would continue to manage liquidity in both directions. That means it will continue to take out liquidity and at the same time would infuse liquidity as and when required to maintain it at a healthy level. So they will continue to do VRR, which is a variable rate repo, where they infuse liquidity, and when they intend to withdraw liquidity, they carry out VRRR, that is variable rate reverse repo. So they will continue to use this tool to manage liquidity so that it remains within a threshold of say maybe 2 lakh crores, so that it is not inflationary. At the same time, it provides sufficient liquidity for the financial markets. Now, if you look at the SDF rates, we have seen that it has continued to go up. So from the April policy onwards, what we have seen that the total rate hike, because I am taking that rate hike also because the reverse repo rate, which was at 335, was suddenly shifted. That's why it is showing in my chart, which has been kept constant to 3.75, which is the blue line you can see in the chart. So, till then, reverse repo was used. And after that, RBI shifted to standing deposit facility. So it moved to 375. So from 335 to 540. So, obviously that, we have two rate hikes of 40-40 and then 50-50. So 180 basis points rate hike has already happened. And as I speak to you, the 10-year GSEC after the reactions, it is close to 7.3%. In terms of the the growth numbers, the MPC highlighted that the credit growth has actually picked up. This is shown by the chart here. It is closer to 14.1%, and the deposit growth has actually come down from the peak. So now we could see there is a gap between the credit growth YOY and deposit growth YOY. So this shows that economy is healthy, it is recovering, and it is on a path of growth. So that's a good indicator for the Indian economy. At the same time, the banks are improving the rates or hiking the rates so that they can attract deposits, because it is also needed to pass on the credit. One important factor which the MPC highlighted, which shows that the economy is healing and it has on the path to recovery, is the capacity utilization. So capacity utilization is has almost moving towards 75%, which is almost, I would say, moving towards pre-pandemic levels, and which is a good level to show that economy has actually started healing and it is path to durable growth. So this actually gives a lot of comfort to RBI that they can continue to focus more on the inflation, controlling inflation. So in fact, in RBI's press conference also, they mentioned that they are in a position where they can focus more on controlling inflation and to bring it back in their comfort zone, which is 4% plus minus 2, because the growth is expected to continue on a durable basis. Now, certain factors more on the inflation. So MPC retained their inflation projections for the fiscal year at 6.7%. However, they mentioned that the trajectory of inflation will depend upon lot on evolving geopolitical situation, because as we have seen that the commodity prices, which you had seen earlier, had inched up substantially. The food prices, the edible oil prices had inched up substantially during the March-April levels. And the trajectory still remains uncertain, though if you see the crude oil prices, they have come down to $94 a barrel. Similarly, we have seen that food prices have started to come down. And in fact, if you see the food index, which is given by the United Nations FAO, they show that it has started to trend downwards. Similarly, the edible oil prices. What it means is that there is some improvement in the global commodity prices, and inflationary expectations have started to stabilize and start trending downwards as the commodity prices move down. However, the geopolitical situations are still evolving, and it is going to be a volatile path the way it goes forward. And also, we have seen recently, some skirmishes with the China-Taiwan. So we do not know how the trajectory is going to evolve. So one needs to be cautious, and that's what RBI has done today by increasing the repo rate by 50 basis points. Crude oil prices has eased, but remains elevated and volatile, and supply concerns are still there. We have seen that natural gas prices have gone up in the spot prices, and that has put a lot of pressure and on a lot of economies, which are vulnerable to that, because Europe is paying very, very high price to get these the natural gas. So that is putting pressure on global supplies of natural gas. Supply pressure, we have seen that in order to anchor the inflation and support the economy, government reduced the excise, and the states have reduced the VAT on diesel and petrol. So now, obviously, this has to be supported through various subsidies, which the government has done. So definitely, it would put pressure on the total supply of Government of India securities and STLs, that is state development loans. So the year's fiscal deficit is budgeted at 6.4, but actual deficit may be higher, or maybe in the range of, say, maybe from 6.4 to 6.8 because of increasing subsidies. However, there is a silver lining. A robust GST collection would help to cool the fiscal pressure. Market uncertainty is definitely there because escalation of geopolitical situations, then accompanying surge in international crude oil and other commodity prices. The financial conditions has actually tightened globally. So we have seen, over the last few months, that there is a coordinated hike by the global central banks across the globe. We have seen in US, Europe, the UK, the Reserve Bank of Australia. Across the globe, we have seen that central banks have started to hike the policy rates. And not only that, they are started withdrawing the liquidity from the system. So that's definitely going to put pressure and tighten the financial conditions. And there is a direct impact on what I will call is on the currency that we have noted. Suddenly, we could see that dollar has strengthened, and not only Indian rupee, but the developed economy currencies, the emerging market currencies, they all depreciated against the dollar. So that we have seen, and RBI has continued to manage the INR volatility by intervening at points of time to cut down on rupee depreciation volatility on the both direction, but should not appreciate or depreciate substantially over a short period of time. That's what they have done. One concern which the MPC or the RBI also highlighted in the press conference was definitely from the tightening financial conditions which are posing right now. We could see pressure on the Indian rupee. The currency could continue to depreciate because in our trade deficit has suddenly increased. It was $31 billion last month, which was around $26 billion in the month of June. So obviously, when this happens, there is pressure on the Indian rupee because the current account deficit goes up. And we have also seen portfolio outflows from the domestic market. So that's again a cause of concern. So that was also one factor where pushed RBI or the MPC to hike the policy repo rate. MPC, as mentioned, with the continued withdrawal of accommodation, in fact, it is already done. The liquidity has been brought down to 3.8 lakh crores, what we used to be having upwards of 10 lakh crores a few months back. So there is already it is on that path. So we expect that this a withdrawal to continue in a gradual fashion. Now, with all this geopolitical macroeconomic situations happening, what we believe is that the interest rate environment in the near term is expected to remain extremely volatile, which we have seen. In fact, the 10-year had touched 7.15 at yesterday's close, and today it is close to, I think, 7.30. So that's a kind of volatility in the near term we could see, and it was also visible in the US markets also, where we have seen that the US yield, from 3.4 came down to 2.5 for a period of time, again back to 2.7 levels. However, it is to be noted that, as I mentioned, RBI has already hiked the policy rate by 180 basis points. The absolute yield levels are very, very attractive. So if you look at it, a 5-year GSEC is close to 7.05%, 10 years is at 7.3%. These are very good levels. So on the absolute basis, yields are very attractive. In the near term, one could see volatility and some uptick in yields also. But on a medium to longer term horizon, these yields are attractive to invest and remain invested for a longer period of time to get a decent return, better than your traditional fixed income instruments. In fact, it is much better today. In fact, if I compare it with even small savings schemes, which is at 7.1%, and if one remains invested for more than 3 years in any one of these debt funds, one could get double taxation benefit also from indexation benefit from there also. So if you ask me, what should one do at this juncture? Invest in a fund which keeps investing in a medium to longer term horizon. Stay invested for a medium to long term horizon. You would definitely make a good return over the existing fixed income products. So we have a basket of fixed income products. If you ask me, our corporate bond funds, medium duration fund, and now even gilt fund we have, they all offer a very, very good entry point at this point for investors to make good returns over a period of 2 to 3 years. So that's all in a nutshell about the MPC and the future outlook and what would be the way forward. Now, one more point which I would like to highlight here is that going forward, do we see more rate hikes? The RBI in the press conference definitely highlighted that the situation is very dynamic. It would remain data dependent. So yes, there could be more rate hikes. It could be 25 basis in another two policy rates, maybe another 50 basis. But even then, I would say that uh, a large path has already been covered by the rate hikes. So further rate hikes would be minimal, and the quantum would be lesser. So that's how we see the rate trajectory going forward. So back to you, Aarti, for any Q&A.
Sure. Thank you, Parijat. And I think that was a very brief sum up that we heard from you, with volatility, playing its game, with the, stance kind of getting withdrawn. There are multiple questions coming in, for us this evening, both on the YouTube platform as well as on the question tab. Let me bounce it off to you, Pari, one by one. The first question has come in from Mr. Vishal Shah. And he is asking us this evening, what will be the peak rates for RBI in India before they stop hiking rates? That's the first question. And then there's a second part to the question, that he's wondering if they may consider to cut rates again. And also the expected timelines, some kind of a guidance Mr. Vishal is seeking from us. Over to you.
Yeah, a very good question. See, in fact, what our, the in-house analysts tells us, that the RBI would definitely look at inflationary trajectory to hike rates and to bring down. So definitely for the first, 3 quarters of this financial year, we expect inflation to remain closer to 6.5, between 6.5 to 7 kind of a thing. And only in the latter, the last quarter, we could see it trending below 6%. So from that view, what we believe is that because monetary policy works with a lag, so whatever rate hike has happened will start playing out. So what we understand is that there could be another 50 basis hike, as I mentioned. So maybe 590, but it will not be in one go. RBI may do at 25 basis plus 25. So I'll give you a range, because to pinpoint is very difficult. The range could be anywhere from 575 to say 6.25. So that's the range that we see RBI could go as of now at this juncture. And the second part of your question is that would they cut rates? Yes, because no cycle remains constant. The cycle would turn around because cycles become shorter. We could see some time in the next financial year, that is FY24, maybe in the second half, when inflation has actually trended towards their 4% mark, which they are looking at. So that will take little time, but that's when we see that, RBI will start doing that.
Right. Thanks, Parijat. And the next question is coming in from Mr. Raghavendra Venkatesh. He wants some guidance on, what kind of mutual funds can be sold right now. Yeah. How we can sell, funds at this point in time. Some kind of a quick guidance on which segment.
Yes. Now I would say that the time to remain on extremely low end is not there, sir, because substantial rate hike has already happened, because yields have already moved up. And now further rate hike, the quantum, I would say, is limited. It will not be another 180 basis rate hike. It may happen, but obviously then, we can, fathom that where the economy would be headed. So from that point, one can look to invest in 2 to 3 year horizon, like in corporate bond fund or a gilt fund or a medium duration fund. The only way to think like is this, that you are getting a very good accrual, say maybe at 7.25, as I mentioned, a 5-year paper. What will happen, even if there is some rate hike in the near term, you will get some MTM losses. Your accruals will continue to give you benefit. And as and when, after a year and a half's time, when RBI starts cutting the rates, so whatever MTM losses you see today will start coming back to you. So if you stay invested, say maybe for a 3-year, you will definitely get above 7% kind of a return. Or, I'm just giving one example. So this is how one can look at investing in the debt funds as of today. So please do not look at short-term volatility. You may see that, returns are maybe negative for a month. but that is not only there because your accruals are still coming and some M2M gains would be there when the rate cycle turns towards, reducing.
Right. There's another question that's coming from Mr. Rajdeep Bhattacharjee, and he asks, when will market recover? From Guwahati.
Equity markets?
I think it was generic market. Maybe you could just probably talk about both.
Yeah. See, fixed income markets, as I mentioned, higher yield is definitely warranted so that you get higher accrual, which is already happening. And, if you stay invested, as I mentioned, the returns are definitely better than FD returns or your, the small saving returns, because you have seen, as I mentioned, the 5-year paper is close to 7%, a GSEC, that is a sovereign paper. And if you take, AAA rated PSUs, they give you another 30-40 basis spread over this. So that's how the return is. On the equity market, markets will definitely look at the growth and inflation dynamics. As the inflationary conditions starts to reduce, that would happen over a period of time because the global central banks are taking action towards hiking rates. We could see that the equity markets also start to recover, and they've already started in fact, they're factored in that happening, because you have seen that Nifty has actually moved up from close to 15,000 to 17,300 in a month's time. So one has to remain invested to benefit from both the markets. That's the key. So it may take some time. Near term could remain volatile, but from a medium to long term, it is a very, very positive, depending upon your risk appetite.
Right. Thanks, Parijat. In fact, from Mr. Pallav Ved, who's calling in from Mumbai today, he has a very specific question for you, Pari.
Yeah.
And he says, why gilt and long-term yield are not rising in tandem with the RBI policy?
Sir, it's a very, very good question, sir. What happens, sir, that, when RBI hikes the rate, so now what happens is that earlier when we had seen the repo rate was very low, 335 during the pandemic period. And your 10-year used to be, say, maybe close to 6.25. So the spread you see was very substantial. So as the RBI hikes the policy rate, the shorter term of the curve, which is maybe up to 1 year, starts to rise. But not the 10-year would rise or a 15-year would rise in the same fashion 50 years. Because what happens as you keep hiking the rates, it also impacts the growth, because the entire cost of doing business goes up. So a slight slowdown in growth starts to building. So what we see is that, a healthy economy, the spread between a 1 year and a 10-year would remain only 75 to 100 basis. So that's how it is playing around today. So the curve moves based on the economic projections going forward. So a long-term rate of 10% is not sustainable. So that's how it gets built in.
Right. Thank you, Parijat. And there are a couple of more questions coming in. I'm going to take them, with you. Mr. Anand from Hyderabad has a very specific question. The government borrowings, the entire program is very high. Will it not push up GSEC rates further up? Is his question to you.
Yes. If you have seen in my slide, I had mentioned that the fiscal deficit at 6.4% is definitely high and could put pressure on the GSEC yield. But the market has already factored in that if they increase it further, from here, because market adjusts that these kind of borrowings can be absorbed by the market, and then based on that, the market levels are determined. But if it increases further from here, yes, there would be upward pressure on the yield. Definitely it would be there.
Right. There are questions coming in on the rupee. This one is from the YouTube platform from Mr. Motiwala JS. With the differential in interest rates between India and US increasing, what would be the impact of the same on dollar flows into India? Pari, I'm also clubbing a question by Mr. Sanket Patel from Mumbai, who's also asking us our views on the impact of the rupee against the dollar after these hikes.
See, because, in order for rupee to remain stable and not depreciate, the interest differential has to be high so that the inflows start coming in. So that's also one factor why RBI chose to hike the rates. So once you hike the rates, the interest differential, has increased so that the inflows could start coming. It becomes more attractive. Our interest rates compared to the US rates becomes attractive. So if you have noticed, whenever there is some currency depreciation starts to, move very randomly or, in a very volatile fashion, RBI takes out the liquidity and hikes the rate. That's normal, economic, policy tool which everyone does. So hiking the policy rate helps rupee to stabilize. But obviously, if RBI had not done this rate hike today, rupee would have definitely depreciated sharply. So that is where the connection is, that the higher the interest differential, the better is the rupee level, or in terms of the volatility.
Right. Thank you, Parijat. In fact, one question on equity markets, from Mr. Indrajit Singh from Patna. He's asking, after this announcement of, the MPC, the credit policy, how should an investor allocate money into equities at this juncture, is what he's asking.
Sir, after this rate hike, because, equity markets also project or run much ahead, and these are all factored in. So as I had mentioned earlier, equity markets are for a longer term. So depending upon your risk appetite, if you do not like too much volatility, as I mentioned, markets would remain volatile in the near term. Longer term, yes, you are definitely going to make substantial return. Equity markets generally give between 10 to 12% return over a long period of time. So if you do not like volatility, we have a balanced advantage funds where it gives a decent return but less volatility. However, if you are, can take volatility of the equity markets, then definitely, a flexi cap kind of a fund would be advantageous to you. But one has to understand that you need to remain invested for more than 3 years, because that's how the cycle works.
Right. Parijat, there are questions coming on the recent gilt fund that we've just
launched.
closed. How, what's the kind of maturities we are planning to run, and will the strategy change right now with today's announcement?
Yeah. See, in fact, the strategy would have changed looking at what was yesterday's levels. But looking at today's levels, our strategy remains same what we had spelled out at the time of launch. So if you look at the curve, and from the risk reward perspective, the spread between a 5-year and a 10-year is not substantial. It is just around 25 basis points. From the risk reward perspective, it looks that the 4 to 5 year bucket is very attractive, because if you look from 3-year perspective, the idea is to ride the yield curve as and when the inflation is back within the 4% zone, and RBI starts reducing the policy rates, so that one gets M2M benefits also there. So that is the zone we are looking at this juncture. But yes, going forward, if the trajectory changes, we'll also relook at our strategy.
Hey, thank you, Parijat. There is one question coming in, on the geopolitical front from Mr. S. Gauri Shankar from Bangalore. And he is asking, if the war breaks out with China, and Taiwan, the things that are happening right now, what will be the effect of this on the global and domestic markets in generic?
That is, one should not even think that it happens, but if it happens, please try to understand the kind of trade which happens between China and US, because if it happens, roughly around substantial trade is between China and US, and also Taiwan, because that's a major semiconductor manufacturer, and the strait that is between China and Taiwan, that is a major trade route, through that it passes. So definitely it is going to impact the global markets, substantially. We could see inflation spiking substantially, because that would disrupt supplies, because China is a major supplier, and US is also a major economic a buyer for these commodity the products. So we could see substantial jump in inflation. Inflationary expectations will shoot up. There would be pressure on currencies, and a whole lot of issues would crop up. So obviously, in such a scenario, we could see the yields spike, equity markets crash, and there could be a lot of trouble, I would say, if this happens. But what I understand, no one wants that. So even the two superpowers also don't want that.
Yeah, God forbid. So thanks for that, Pari. There is one more question, which is completely on the shorter end of the curve. On the fixed income space, what are the opportunities that are lying right now for an investor?
Shorter end, I would say that we have one can look at liquid fund and money market funds. These are the two funds which are at a very short end, maybe less than 1 year. So liquid funds would continue to deliver better returns if you are for a short period, because as the RBI hikes the rate, so because liquid returns are generally 25 bips higher than your or closer to the SDF rates. So SDF rates is 540, one could see around say 5.5 kind of a return could be there, that range. So liquid fund and money market funds, these are the two short-term funds where one can look to invest.
Right. Thank you, Parijat. That brings us to an end of a rapid fire Q&A. And thank you once again to all the participants who are on this webinar platform, as well as on the YouTube channel, who've heard us out this evening. If you have any further questions, kindly contact any one of us. And once again, I take this opportunity on behalf of the entire team at Union Mutual Fund to thank you for your valuable participation. Thank you, Parijat, for sharing.
Thank you. Thank you all. Thank you, viewers.
Recording stopped.